All right, so all this political tension in D.C., questions about the House Speaker, getting the election certified. Does that actually matter to investors?
Well, look, I do think that investors will really care if this is an indicator of whether the Republican majority will work together to get things done or, again, fight amongst themselves. So that'll be useful, I think, in a process. I'm not going to argue that it's going to be the difference in whether stocks rise or fall today. But as we look deeper into 2025, this is just going to be one of those indicators. And obviously, the process last year showed that there could be a long and arduous process. It doesn't really mean that much over a short period of time. But once you get through this and you get deeper into 2025, all sorts of issues will arise. In the second quarter of the year, the Republican majority will deal with their own increase in the debt ceiling. So these are the types of issues that markets will care about and really assess the functioning of the new Congress.
All right, so it sounds like this could impact sentiment. So kind of leaning on that thread of impacting sentiment, President-elect Trump, he has backed Johnson to be the House Speaker. A big part of the rally we saw post-election was the idea that President Trump would have a lot of support down in D.C. He would have support in Congress, support in the Senate. If Johnson doesn't actually become the Speaker, or if this becomes a prolonged process, does that change investor sentiment about the idea that the Trump policies will be enacted when he takes office, that he'll have a lot of support when it comes to Congress? Does that change that narrative and change what sectors you think people may want to invest in? Things like small cap. Cut you off.
There are a lot of ifs on that particular one, on the particular personnel issues. But clearly we have a different outcome than all of the potential that we saw in the pre-election period. There have been big reactions and there's been profit taking on various reactions. You know, we would still think that deregulation beneficiaries, there's going to be a flurry of activity from the new president regarding executive orders that will affect industries, the ability to build natural gas pipelines, natural gas exports, just simply not increasing the burden on the financial system again. These are things that are going to happen anyway. It's not going to change the directory of U.S. growth. We've seen a sharp pickup in small business sentiment. And of course, on the negative side, there is great tariff uncertainty. And of course, the scope for the headlines over tariffs is a lot bigger than what we think the reality will be. But these
Steven, let me interrupt you. You're trying to be a rational voice. You're trying to be a rational voice, but I think over the last few years, we've seen that D.C. isn't necessarily rational. I want to ask you about another factor that isn't an issue right now, but maybe coming up, the credit of the United States of America. I don't know if you remember back in August of 2023, Fitch downgraded the U.S. credit rating, and here was their rationale, at least in part. A high and growing general government debt burden, which remains the same, and the erosion of governance related to AA and AAA rated peers that is manifested in repeat debt limit standoffs and last-minute resolutions. That seems like a very similar picture to what we're seeing right now in D.C. Should we be concerned about the credit rating of the U.S. being downgraded, or a spike in bond yields if that's even something that some of these rating agencies even signal could happen?
Well, look, there are many different roads to higher and lower interest rates. And the Federal Reserve easing monetary policy, right, making it just somewhat more accommodative to higher inflation is the way that you get a steeper yield curve, not a credit risk premium situation for the United States. You know, we have a lower budget deficit that we did during the pandemic period. I think that we learned a lot from the pandemic period, that the economy is not limitless in terms of how much fiscal stimulus can stoke inflation. And you can see plenty of other stories in the world where this is not the primary driver of bond yields. Japan has doubled its debt relative to GDP compared to the United States at a lower interest rate than we borrowed at for the last 40 years, but the very same budget deficits. So there's been a lot of concern about this thing. It's been intermittent. And look, the risk of not increasing the debt ceiling at some extreme limit can be a worry that can trickle into markets. But I think we learned a lot from the prior decade and see that the political process, as ugly as it seems, as crazy as it may seem at times, really isn't the major problem for markets.
I want to finish on the markets very quickly, Stephen. We're almost out of time, but you're very bullish on small caps right now. We're going to show a chart right here. Rates in small caps, you can see they just move inversely. I know you don't seem to be that worried about a rise in bond yields, but the fact that bond yields have been elevated above 4.5%, they seem pretty sticky above that level, and also a lot of the Trump policies could be inflationary and lead to a rise in bond yields. Look at this chart. I don't know if you can see it too, but they're certainly moving inversely. Doesn't that make you concerned about the small cap trade? I mean, doesn't that seem to have unwound a bit, especially with the Fed signaling fewer cuts?
Oh, sure. First of all, we want to be careful, be quite discriminating about small caps. If you take a look at small cap growth companies that are already profitable, they're trading well below their long-term average valuation, complete contrast to large caps. These are not, again, the leveraged companies, right, that really constitute, or the unprofitable companies that are in the Russell 2000. You could take a look to S&P indices, the 400 and 600, for example, and try to take a look at growth companies. Again, these may be lower beta companies, but we think that they're undervalued. And then the final point is that why interest rates will rise. We're expecting uninterrupted economic growth, barring any shocks, through 2026. If that's the case, the steepening of the yield curve that we get from Fed easing is generally being driven by growth expectations and a recovery in profits for smaller mid-cap companies. That's what's really key.